The S&P and the NASDAQ on track for their best weekly performance since November. But, of course, that's a bounce back. To discuss what's next for markets and your investments, let's bring in Jeff Weaver, Allspring Global Investments, Senior Portfolio Manager here. Jeff, good to have you here with us today. So let's put this move this week in context here, and ultimately for the buying on the dip mentality that has seemed to reemerge, where you're seeing investors kind of flow in right now.
Yeah, thank you, Brad. Thanks for having me. My focus is on short-term bonds, and one of the things that has the market excited was this week's CPI report. The CPI report came in really as expected, up 0.2%. The headline CPI number down to 2.9%, and so this number is good for the Fed. It's good for the markets. It's good for the consumer. So. I think with rate cuts on the horizon, I think that's, the market is certainly embracing that. We still have a strong economy, though. Retail sales was higher than expected this week. Jobless claims were lower than expected. So, there's been some concern about an increasing unemployment rate, but right now the markets continue to trade well, and interest rates are coming down at the margin, and that's what's driving a lot of flows.
And, we had some fresh commentary from Austin Goolsbee, the Fed out earlier today, saying that he sees some leading indicators of recession flashing warning signs right now. How should investors read into that and adjust their portfolio strategy, if at all?
Well, I think that is the risk. The risk is that we are seeing the unemployment rate climb. It is at 4.3%. We were at 3.4% last year. So there is some concern that an increasing unemployment rate continues to increase, and that we potentially move into recession. That's the risk, and I think that's why Goolsbee and other members of the Fed are certainly preparing to cut rates at their September 18 FOMC meeting. They want to make sure that they move their what is now considered a rather restrictive monetary policy to be one that's much more neutral. So by decreasing rates, they can help avoid the risk of recession.
And certainly, and with that in mind, as we get into that broader pathway, where would investors be apt to best really kind of consider how the Fed may move and the pace at which they will move in order to continue to modify their own portfolio in accordance and in anticipation with the Fed's policy pathway?
Right. Well, we do expect a 25 basis point rate cut on September 18th. We'll probably see a 25 basis point rate cut again in November and then again in December. So that is a slower path than what was expected perhaps earlier this week. Last week, there was a lot of anticipation of some pretty dramatic rate cuts, but really the numbers that we see are more balanced. We at Allspring Global Investments have been encouraging investors to extend duration of their fixed income holdings, have been encouraging folks to increase their equity allocations because there has been such a growth in cash. I mean, cash has been so attractive. Money market fund yields at 5% to 5.25%. It's a really nice place to be. But there is, the risk that as rates come down, the money market rates are so correlated with the Fed funds rate that those rates will come down, and that there are opportunities elsewhere. So we do encourage those that have excess liquidity or no liquidity needs, that they do put that money to work in the markets, and have been encouraging that. But nonetheless, cash rates are going to remain attractive. We saw $1 trillion come into money market funds last year. We've seen about $280 billion come in this year. So they're going to continue to remain attractive, and really have money market funds will continue to have a good place, a good place for your money and as part of your diversified portfolio.
Jeff, just quickly here, when you're saying expand the duration of your fixed income, are you saying, look at longer time horizons for some of your investment vehicles that are leaning towards government or even corporate bonds?
Yes, that is the case. In our money market funds and our short duration strategies, we've been extending duration. This benefits your portfolio as rates come down. And we do think you don't have to go very far out the curve to benefit from rate decreases. Even going out just to 1 or 2 or 3 years, as rates come down and the curve normalizes, we would expect those securities to perform well.
Jeff, thanks so much for taking the time here with us today, kicking off today's show. Jeff Weaver, Allspring Global Investments Senior Portfolio Manager. Jeff, good to see you.
Fantastic. Thank you very much.